All right, Aristotle, let's go ahead and get into some of your points because I think we're stealing some of your thunder here.
And this is a roundtable discussion, so yeah, we don't want to get too sidetracked, but it's great to talk about all this stuff, and they all synergize. I don't like to use that word, but synergize together. They all mesh together here. So thanks. So let's talk about expectations. So I'm sure you guys also have members that come to you and they expect to buy a property with X amount of return or price point. And that is just not realistic in some cases. So, and we have to compare apples to apples, right? Because you're comparing a $50,000 property that needs work compared to a $90,000 or $100,000 property that our team offers that is fully renovated. That's a completely different type of product. So we definitely want to be aware of that. So let's talk real quickly about cyclical and linear markets. So my first bullet point says some markets have seen double-digit appreciation, while others have seen single-digit appreciation. And so what that means is that the double-digit appreciation that you're seeing in places like Jacksonville or the Dallas-Fort Worth area or Charlotte, a lot of the growth areas that we mentioned earlier, those are considered what's called a cyclical market. And those are markets that go up and down big time. So they have big swings, like San Francisco, Denver. Ben mentioned a bunch of those, and then there are some hybrid markets, which we didn't really put that in there, but a hybrid market is something that's kind of in between. But cyclical markets are the ones that have the big ups and downs. And then the linear markets are the markets that just stay flat. And those would be like a Cincinnati or a Cleveland or Indianapolis, Birmingham, and so forth. A lot of Midwest cities tend to be more linear. And those are great for people who really don't want to risk the big downs if a downturn does happen in that specific market. And so they're both good. And that's what's great about our network is that we recommend for investors to purchase maybe some properties in cyclical markets that are going up right now, because maybe in 5 or 10 years you can sell it and exchange it for 2 or 3 properties. And we also recommend to get some linear markets that are just stable, boring markets. I personally like linear markets. That's just how I am. But that's the expectations, that you are seeing a lot of appreciation in some markets, and in other markets you're not. So if you're seeking higher returns, aim for linear markets, and more appreciation, aim for cyclical. So again, just you have options there. And we do have some, again, primarily in the Midwest of the US, and we have a few markets in the Midwest, again, Cincinnati, Indianapolis, Chicago, and then down the South, Birmingham. Those would be considered linear markets. And so those are great for higher returns. And the reason why is because the price points are so low. So I don't want to get into technical things, but price points in those linear markets are generally around, right now, they're generally around 150 or below. We're not seeing too many properties below 100,000. There are some, and again, I'm talking about a renovated property. We're not seeing too many below the 100, the sub $100,000 range. But and then in most cases, markets that have seen double-digit appreciation have lower cash flow, and that is certainly the truth. Again, markets in a lot of the Florida markets that we're in, a lot of the Texas markets we're in, Georgia, all those, you're not seeing 12% cash and cash returns there because the prices are $200,000 to $300,000. So again, wanting to paint a realistic expectation to you guys who are looking to buy property.
Aristotle, if you have to give people a range of expectation for cash on cash return in a linear market versus a cyclical, what are kind of your expectations in either?
Yeah, so and you guys can chime in too, but generally I would say on the linear market, again, price points are still around 150 or below. They could be a little higher, but if you're leveraging and you're putting 20% down, again, a projected cash flow or cash return would be, on a linear market, would be anywhere from 8 to 13%, let's just say. On a cyclical market, it might be 5 to 8%. Is that about right, you guys?
Yeah, I'd say so. We've probably seen the growth ones go down a little bit more even recently. I've seen quite a few performers lately with 3 and 4% cash on cash returns in those cyclical markets.
Yeah. So yeah. All right. So let's go to the next slide here. I have a couple other bullet points. So, and we're going to talk about new construction a little bit here, and I want you guys to help me out with this too, because I think all you guys, except for me, have actually bought a brand new construction house, and that's what a lot of our members are buying and have been buying for the last couple of years, because it's easier to secure a property and know that you're going to get something without having to not just make offers, but have to go through the whole deal of searching for property for months and months. So new construction homes do tend to appreciate at a faster pace than an older home, and that's because of the demand. You know, if you buy a brand new property today, and 10 years from now, a millennial that wants to buy a home, if you're looking to sell your home on the open market, that millennial would be more apt to pay more for that property because it's only 10 years old versus a property that's built in 1920 that's 100 years old. You know, where the door frames are like this wide, you can't fit a master, or you can't fit a queen bed in there or king bed in the bed. You know, a lot of people don't want those. So they're great for rentals, but again, on the open market, if you're trying to sell at retail, people don't necessarily want those. They might prefer a newer home. So you're going to have a lot more appreciation in that type of product. And then new construction homes have the possibility of price increases while they're under contract, and this is a big thing. Normally, I think probably, I guess, yeah, pre-pandemic, the notion through our network was, hey, you could buy a property, lock it under a price, and that price, you're locked in. You don't have to worry about the price going up and down. But boy, has that changed. It's dramatically changed. I've even had friends who are buying homes from like Lennar and KB Homes and Pulte Homes, and some of them, I don't think Lennar, but I know like Pulte Homes, they actually, you can go into their office and they say, here's the price, and we are taking offers on a brand new house. And that's crazy. We've never seen it before. Never in the history have you had to go into an office or a new construction home hoping that you get the property because someone else is going to outbid you. It's crazy. But since you guys, I'll let you guys take the reign real quickly, but since you guys have purchased a brand new home lately, can one of you guys maybe elaborate on what the price increases are doing and what they mean to people who are looking at new construction homes through our network?
Well, what I would say, a big, huge differentiator, and I'll answer your question in a second, I'll circle back to it, between new construction and rehab is patience. You have to have a lot of patience to buy a new home. Now, there are some exceptions. Every once in a while, one of our property teams come out and they go, hey, you got these homes and they're available, you know, in 90 days. But most of the time, it's like a 8 to 18 month delay time between the time that you commit to something, sign a contract, put EMD, earnest money deposit down, and actually get the home as a income producing asset. So, you know, for me, being about the most impatient person that I know, it's really painful to have to wait that long. So I always just, you know, hey, there's nothing wrong with new homes, but I just make sure people really understand that. And I think to answer your question, Aristotle, how the supply and the cost of it's kind of taken some of the luster off of that, because at least in the past, you could lock into a price and go, yeah, it's going to take a year and a half, but it's an appreciating market and I'm locked in, and now you're kind of not. So it in my mind, it takes some of the luster off, but that just really bugs me. I don't like to wait. You know, if I've got $50,000 burning a hole in my pocket, I want to put it to work for me now. I don't want to have to wait.
Yeah, I don't think builders anticipated. I mean, I don't want to, we've all been beaten to death with the COVID excuses, so I hate to pile on another one, but like nobody could have anticipated like all that would collide at one time. You know, the permitting process in some of the areas in Florida just got so backlogged because we heard the city, they were all working from home and they went to skeleton staff, and you know, you've heard the excuses. And so permitting was suddenly taking 8 months instead of 2. And then meanwhile, you know, we all know about the supply chain issues with lumber and steel, you know, and so meanwhile, these builders who have contracts on these properties, they've in their mind kind of anticipated what all the costs would be. Now suddenly they're 8 months, sometimes 12 months removed from that initial pricing, and their prices have quadrupled. And, you know, I think Aristotle, to reiterate your point, like, this time last year, when we were really promoting new construction and we were saying, lock in your prices, we had no idea that this was a possibility for builders to come back. And I think it's important to clarify, it's not that builders were just saying, we're raising the price and you have no way out. They were basically exercising a termination clause that most builders keep in their contracts. And they were saying, we're going to exercise this clause to terminate the sale of this property. However, we want to sell it to you. We want to work with investors. but we can't take a loss on this property. We're upside down. And so we're going to work with you and let's find the win-win. And many of our builders were, you know, finding a good medium spot where they weren't stepping up the pricing all the way to market value like they could if they wanted to. They could go and sell it on retail, right? But they were willing to kind of split the difference with the investor so that it was still fair for them to be able to feed their own kids, right? So it's been hard to have that conversation with so many of our investors who've been impacted by that.
Yeah.
Right. Yeah. And so just to kind of recap, and we'll move on here in a second, but just to recap, and Joe, if you have something to say, I would love to hear what you have to say. But just for those who are listening who are interested in new construction, most of the builders we work with, if not all, there's a few, but most of them have a clause in there that gives them the right to raise the price after you go into contract due to an increase in materials or labor, et cetera. Now, you do have the right to cancel the contract. Unless I'm not saying that correctly, but you know, we've had people who bought a house and they put a house under contract, and then 4 months later it goes up by $30,000. So we just want to be realistic with you guys and say that can happen. Lumber prices are not skyrocketing like they were, but other things are. You know, shortage of labor. You know, electricians used to be $90 an hour, now they're $150 an hour, whatever it is. I mean, that is increasing, and unfortunately that goes to the bottom line of the buyer. So.
And one other thing that's adding to the appreciation of new homes is the COVID crisis, because a lot of people we find are really interested in having a new home that no one's lived in before, especially at the beginning. And so that increases the demand for brand new construction over a house that's 50 years old or 100 years old. And that's contributing to the appreciation and the increased demand for new construction.
Yeah, good point.
I'm going to just jump in here and mention that Russell asks a pretty good question here. With buyers clamoring to purchase homes, why are some contractors, builders, willing to work with your investors instead of waiting for a bidding war? And I mean, I get that question all the time. People are like, well, why wouldn't they just sell on the open market and make 10 or 20,000 more? And this is the same thing. It's because a lot of rehabbers or builders would rather work with investors in many cases because they buy more than one. And if you're just selling to mom and Joe and Sally, they're going to buy their one house, live in it for 20 years. You'll never see them again, most likely. But the investor tends to buy more, so it's kind of a repeat purchase. And they want to retain integrity. Hey, we committed to this. We're going to work with you. We might have to raise the prices a little bit, but we're not going to raise it all the way to retail, like Leah just mentioned. And that's why they don't want to throw it out to an open market. And quite frankly, also, investors are usually easier to work with. They're not worried about what shade of green, Kelly green or parakeet. Are you going to do the bathroom? They're just not worried about that. So it's a lot less brain damage for the seller as well. So I think those two combined are why they don't do that.
Yeah, very good points. Okay, great. All right, so moving on here. So there are still a few markets that we recommend that provide more cash flow than others. So again, markets like the Midwest, Cincinnati, Indianapolis, Chicago, Birmingham, Alabama, they do offer a bit more cash flow because the price points are lower. And then with the huge demand of historic low interest rates, expect prices to keep rising. So again, what Joe was talking about, supply and demand, that's what this is all about right now. It's not about a bubble. It's not about what's going to happen, what should happen. It's all about supply and demand. And right now, demand is ultra high, and it probably will remain like that for a while. Let's see, go to the next slide. I think there's a few other things on here. Oh, that was it. So one thing I wanted to say real quickly is I'm writing an article, or I wrote an article. It's almost about done. It'll be posted on our website in the next couple weeks about forbearances and foreclosures. And it's important to note that when the pandemic started, and this is really important to note, when the pandemic started last year, there was over 7 million homeowners that went into forbearance. And a forbearance is an agreement that homeowner can go into with the bank or they're servicing their lender to delay payments or just for, not stop payments for a while because they lost their job, etc. Do you guys want to take a guess of what that number is today? How many people are in forbearance?
2 million.
Close, 1.5 million. So 1.5 million people right now in forbearance. That is amazing. So in the financial crisis in 2009, there was over 9 million homes that went into foreclosure. 9 million. Right now, we're down to 1.5 million that are possibly at risk of foreclosure. So for those who are waiting and saying, I'm going to wait for foreclosures, you're going to be waiting for a long time. And I'm not just trying to say that. The data is showing that there's really not a lot of foreclosures coming. So, and again, I'm not advocating, hey, go run out and go buy a property right now. But what I am saying is that prices are going up and they probably will continue for some time. So if you're waiting on the sideline, you've been waiting for a year, I would recommend you get into an investment property soon because you're going to miss out on the low interest rates. That's all.
Yeah.
And how many, you just said that number, but how many were in forbearance at the beginning?
About 7 million.
Wow, so
year.
seven down to 1.5. Wow.
Yeah, and so those people, the
Well,
reason
it
why
tells you how much it was.
Oh, sorry.
Go ahead, Aristotle. You're going the same direction I am with it. Go ahead.
Oh, so yeah, so of that amount, the reason why people exited or were able to get out of forbearance was either they sold their home because of equity, right? Like tons of people have equity in their homes, like over 90%. I think they said the number of people have equity in their homes. So they either are selling their homes, which unfortunately not enough of them are selling because we're not seeing as much inventory, but they're either selling or they've got their jobs back or they're just refinancing and paying what they owe. So they're exiting, and more people will probably exit over the next year forbearance. So it's pretty amazing what's happening right now.
Well, I was going to add too that I think there's probably a significant amount of people who took the forbearance just as a precaution, right? I mean, I was in that camp. I feel like when COVID first started happening and I own all these rentals, you're like, oh my gosh, am I going to collect any rent checks? And before we really understood what this looked like long term, I mean, I had conversations about should we just do this, like just to hoard cash and be ready for for long-term problems. And I know for a fact, I mean, that stat I think clearly supports that there was some people who did it as a precaution and then realized, okay, my rent checks are still coming in, I'm not having a problem, and they get themselves current again.
Yep.
Yeah, exactly. Yeah, Karim asks, or Karim Locus says 15 million. Yeah, either way, it's the data I showed showed 7 million people that were in forbearance. But the bottom line is that so many people have exited that program, and so you're not going to see a lot of foreclosures like people are hoping to see.